But when you look at I mean, this is just, we are back to just bizarro land.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember.
And we are back with another edition of the Daily Dots. And I'm once again joined by the brain trust himself, Mr. Chase Taylor. Chase, maybe it was a bad night of sleep or something. I'm irritated. And in some ways more irritated than other times, just as a guy that's more of a fundamental investor. Just the idiocy is back in full tilt fashion. If you look at the tape today, the dumber your company is and the more stupid it's priced, the better it's doing. I shouldn't be as frustrated as we are. We've hit a new high on the year for us. Our portfolio is doing well. I'm trying to prepare myself mentally to watch these idiotic markets get even more idiotic.
I mean, we do know the trash tends to rally the hardest out of pretty deep drawdowns. So the fact that we drew down 20%, V-shaped it, it's not surprising that the trashy stuff's doing the most.
Well,
I'm a little surprised along with you. I think that some of it is hitting new
highs. That's what I'm talking about.
I'll give you that.
I mean, look, if we're going to get a bounce, everybody knows you want to be in the trashiest names bouncing off the bottom, right? That's short covering, all kinds of things like that. New highs.
Right. No argument here.
I mean, and the incredible thing to me about it, like we were talking about, it's for a lot of these names, the growth is gone. The story behind it, you don't even need a narrative anymore. I don't know where this has been going on for so long. I don't know where this is going or where watching this, kind of looking at the setup, looking at the fact that we're probably looking at rate cuts sometime this year. That whole blow off top scenario, I think, is back on the table. I'm not at all sitting there calling it. But when I look at what is rallying and how it's rallying, I'm back to looking at a market that looks like almost like 2021, where it's got to continue, right? I mean, you're effectively flat on the year, so you can't sit there and be like,
we're only beating 4 countries year to date.
So it's not, but I mean, you're just, you're looking at some of these companies and you're just like, what? Why are you like Tesla?
That one's comical for sure.
And there's a bunch of them, right? To be fair, but I mean, none of Tesla's issues have anything to do with tariffs.
Right. That's why that one's comical to me. Because, if you're like a AI company or a chip manufacturer or in that ecosystem, you can be like, there's a lot of stuff you can point to. You'd be like, well,
that was a big threat.
These things have happened in the news and with trade and with deals and pulling off restrictions and like we're not going to, recession odds have come in. Like all those things are huge force multipliers if you're a chip company. But if you're Tesla, like other than maybe not having a recession, like what has really changed for them? Not much.
The other thing I'll tell you,
in fact, they're going to lose the full blown. It looks like in the legislation, they'll probably lose all the tax credit stuff from the IRA and everything that obviously isn't good for them.
Yeah, I even look at an Apple. Now, Apple's not rallying as hard as the rest of them are, but I mean, yeah, we've said it for a long time. It's just to me, even though these are not the most extreme valuations we've seen, I'm looking at a market that is pricing things even more ridiculously than it was when we were at the highs. Like when you go back to the peak of 21, I mean, I know we were higher in 24, but that was all Meg 7, driven. in 2021, a lot of this nonsense made sense because of what was going on.
You at least had a tidal wave of fiscal and monetary. Just the excess liquidity was overwhelming.
Right.
Like liquidity is fine right now, but it's not like some overwhelming spike, that has taken place recently. It's
just not.
Right.
And
now you're not at those levels of 2021, but you're not that far from them.
And yet one of the things that you and I were talking about is, I mean, if you had to put a gun to my head, I think this has got legs. And one of the biggest reasons I think it has legs is because if you are an active manager and you are sitting on 5, 6, 7% red on the year, and trust me, that's probably the average, right? Maybe slightly worse. Q's going green on the year. You don't have a choice. Either that or whatever capital you have left is going to get pulled. You know what I mean? Like, and everybody knows that, right?
Yeah.
Praise God. We got to lead. You know what I mean? Like, I'm sitting there going, thank God it's making our job. It's making this much easier to deal with. But when you look at this is just, we are back to just bizarro land. And no one can, Carvana, Tesla, and the like you said, these things are plumbing new heights. Tesla back up to a $1.1 trillion market cap as their underlying business is just getting eviscerated. Apple, another one. You're seeing a bounce back in Apple. Apple's problems had nothing to do with the tariffs. Were not going to make life easier on them, for sure.
I would say if you look at where you would have had U.S. and Chinese growth a week ago versus where you would have U.S. and Chinese growth now, like that's helpful for Apple. They can sell more stuff.
But when their growth was trending, when their growth was above levels that we're projecting,
I'm just saying week over week change. Like something has changed there to get the price up.
Yeah, but again, it just goes to the point of how these prices have become completely relative.
Of course, yeah.
Yeah, meaning there is no objective pricing mechanism for this market. We don't price them to rates. We no longer, the days are gone of using rates as a discount method for stocks.
Yep.
Nobody's doing that. Nobody gives a damn, right? Even though that matters. It matters.
So that would only matter to the markets at extremes. Yeah.
Yeah. The other thing I think is, like we were saying, you got to put blow off top risk back on the table. The other thing is, I think there's a scenario here where, and we're not there yet. I'm not trying to be hyperbolic, but if this has any legs to it and you run it into a Fed cutting cycle, I think a lot of the same things we were saying last year about a potential for a runaway market, a blow off top, I think it's back on the table. And when you look at that, I think that could be a very, very dangerous long-term setup. You and I were talking about this. Look, I don't see us there right now. I'm not saying I think this is the odds-on favorite at all. I continue to say I'm not a Chicken Little, and I don't see this market getting killed. But I can see us entering some dangerous territory. And if this has legs, and crypto has legs, you start looking around and taking inventory of how much dry tinder there is and how much there would be if this run has legs. I think that you could be at a scary place in not too short a period of time here.
And for that reason, I'm in an awkward position because I went from being like very much against the tariffs and thinking they were doing way too much, way too fast, and it was putting the whole economy at risk in a really scary way. I've gone all the way from that to being like, whoa, like you've taken too much of it back too fast. So now you're kind of messing with financial stability from the other angle of letting the market go wild to the upside.
Yeah.
So it's a weird spot to be in.
Those days are over though, man. I mean, look, we've got to adjust our thinking on that. When was the last time you heard an official of any kind from the Fed, White House, whatever, regardless of valuations or froth in the market, come out and say anything that was not constructive risk assets?
Well, I don't think that's true. I think they have.
When?
But the market did not care about it. Like people from the Fed have said things about like, oh, like some of these certain asset prices are unsustainable or like that's stretched and like things like that. But
but I'm talking about in the past. Like meaning it it was not an uncommon thing for the Fed to come out and say, and they never use these words, of course, but, irrational exuberance. This market is overheated. We're concerned about, financial stability.
Which they've done over and over and no one cared. Like the market ripped from Greenspan's irrational exuberance comment. Like the market just doesn't care.
No. I didn't say it can't. What I'm saying is but you used to hear somebody at least comment about it. You don't even hear them say it anymore. I mean, they might be like point to a certain thing, be like, we're keeping an eye on this, we're keeping an eye on that.
They don't seem to care much at all.
No.
To your point, the Fed used to have, they used to talk about financial stability a lot, and what they really meant was like, hey, we got to be a little bit careful with bubbles, because obviously bubbles popping becomes its own macro risk. So let's be cognizant of that and not let them form too big. Like that's gone. Like I really like Powell. I think Powell's done an excellent job as chair. I think that's a blind spot he's had as chair, is like, I just don't think he views himself as responsible for asset prices in either direction. I don't think he cares. And it's nice that he's not trying to put giant floors under the market whenever it goes down in 22 and just now. But at the same time, like I don't think he could care less how big of a blow off you have to the right tail. It doesn't seem to appreciate the risk that feeds back in. Even within the Fed, they have like a financial stability, group, and even like their prominence inside the organization seems to have been like watered down. Like people used to really care what those people thought. I haven't heard anything about them lately. They do their little, annual report or quarterly report or whatever, and then no one talks about it or cares.
Yeah, I mean, look, it's not abnormal in market runs. I mean, look, if you, this is not new or unique to this market. If you told me that a market was going to go on a rip, okay, you drop us back in time 40 years ago, and it was going to be a broad market rip, right? You want to go buy growth names, right? Small, fast growing growth. That's where you're going to. So I'm not saying that's abnormal. What is abnormal is growth names that aren't growing, right? Like, meaning that is something that is structurally new in this market. This whole attitude of going back to our buddy Dimitri Kofinas talking about financial nihilism, nothing matters, meaning you're watching names go up because they're winning popularity contests. Even though like everybody can look at it and acknowledge, Palantir hit a new all-time high today. Now officially trading over 100 times sales. And like you said, it's a software company. This isn't NVIDIA. They're not going to have 150% increase in earnings over the next year, let alone 400. It's just madness. And 100 times. I don't think I've ever seen, well, you know what? I bet you there's probably never been a company that is over $200 billion in market cap trading at that expensive of valuation.
Especially with that. And it's not like they're not growing well. They're growing great.
Yeah, they're doing great.
But not at that growth rate.
No. I mean, to make it pencil, I have no idea, just because I haven't sat down and it's so ridiculous. It doesn't even bear the time. But, you probably need to, I would guess probably somewhere between 90 to 130% annual growth to try to justify a price like that. Even then it's pricey.
Right. Yeah.
130, 150% growth.
Now you're talking, it starts to make a little sense. Yeah.
Well, yeah, because then on a 10-year basis, you can sit there and say, okay, if this is trend, we could get there. Right.
Maybe they do, but it's tough to see. It's tough to see right now.
I mean, if I was an investor, I think a really good outcome would be is over the next 10 years is if they grow into their current valuation.
That would be a great accomplishment.
Yeah, it'd be nuts. Then you see crypto ripping the way it is. How big is the crypto space now?
Oh, let me look. I'll look it up.
We got to be pressing 4 trillion, I would think. I would imagine anyway. But yeah, watching some of these things take off and go to new all-time highs. Like I'm watching the rally in Carvana while rates are going up.
3.5 trillion looks like.
Yeah, there you go. So by tomorrow you'll be 4.
Well,
no, but even you're watching rates going up and Carvana rallying with it. on their last.
So, speaking of that, that's something I want to touch on, because that is, so you're talking about the like blow off top potential here. There's a couple reasons I don't see it. One is something we just got wrong. Like we should talk about that. And that is like, I think you and I both had this view of like, well, the market's ripping. That takes a lot of the reason away from both the US and China to go make a deal. Now that it's not a real deal, it's just, let's take the tariffs down and talk. But I still didn't expect that. But I still think that kind of applies. Like, what are the odds they go from like, let's just take the tariffs down, to a real deal with markets doing well? That feels like a low. Like, I feel like that gives Trump that much more leeway to come firing back on trade stuff again. Because like, whatever, if the market goes down 7%, like, we're still doing pretty good. You know what I mean? So I think that's still there. But more to the point, Treasury Secretary has made very clear, like, the 10-year, like, that's the big thing. And if you go back to when they first pulled down the reciprocal tariffs because they kind of got spooked by the 10-year flying higher, we're back. We're like, that's where we're at.
You're back to that level.
4.5%. Now, it spiked above like 4.6 or whatever, but we're back to where, the highest you were ever closed, we're right there. So if the 10-year keeps ratcheting itself up towards 5, like that, I think that's enough governor for the stocks to at least slow down to where you don't have, the work it takes to have another 30% year from here, you're talking about, it has to go up 30% in 6 months.
Yeah. Well, with that attitude, it's not possible, but
well done. So I still, now I think we can easily go see the new all-time high this year. Absolutely. But at the same time, I feel like if I told people, especially if you go back to November when everyone was so giddy and so bullish in November, December, hey, it's going to be May 13th and the market's going to be flat on the year, I think people have been like, no, like, we're going to the moon.
You and I were both on the same page on that one. Again,
low single digits was my call, and I feel like we're on pace.
Well, and I will still look back to November and December and look around, and I remember at the time looking at people going, huh? What?
And one of our arguments was like, there's no wall of worry left because everyone's bullish.
Yeah.
But then Trump built a giant wall of worry and then we climbed it.
Well, that in multiples. I mean, just looking at the state, like just looking at everything, right, the state of the economy, like all that kind of stuff, there was no slack in the rope, meaning, usually when you see a runner like that and you have a year like that, there's slack, right? There's something that accelerates. And when you're trying to do that from 30 times earnings at all time highs, considering the trend that we were on and the fact that growth was trending lower, you're just sitting there going, guys, like you said, it felt like that perfect moment at the top. And it was temporarily, at least for now, just because you're sitting there going, there's no wall of worry left, guys. Growth is decelerating. You got to run multiples from here if you want to experience,
nothing but, right?
No, nothing but.
And that was even with macro, like itself kind of slowing down.
Yep.
Nothing crazy. It wasn't like bad, but it was, growth wasn't like accelerating from the base from that point. It was kind of slowing itself down. Yeah. So I think moving forward, obviously, like, it feels like the trade stuff's kind of just over for the next couple of months, but it may reassert itself at any moment. We talked about earnings this morning. Like, now I feel like maybe you can argue the bar for earnings expectations is actually low and you can jump over it. At full year expected to be 7.5-ish, and we just had a 12% quarter.
Yeah, but that didn't. Yeah, but I think there were a lot of tailwinds in that quarter.
Yeah,
that I don't
totally
think
agree.
You can book.
But I think you could go from having people pulling guidance and pulling down guidance to putting it right back up and raising it.
Oh, well, yeah, we're right. Because again, I was using the Wayne's World analogy earlier today on our investment call. Right? It's just the way this market works. It's out playing hockey in the middle of the street. Game on, game off. Right? It's game on. And when you say game on, risk on, again, we know we're in a market that doesn't give a damn about fundamentals or valuations. So you say game on, everybody's going to buy.
Right. And a few people haven't bought yet. So that's your fuel. Like you said, the pros, like, and systematics. There's still a lot of dry powder in systematic. That's probably climbed itself back up 30-40% of the way.
Yeah.
So you got 60-70% to go. And that's like a $5-10 billion a day clip of buying.
Yeah. The other thing, and our good buddy, Mr. Polanski, this is his, I mean, I wouldn't say it's his brainchild, but I thought he had some very good points and very good ideas as it relates to this topic. But just kind of a teaching moment, or not a teaching moment, but these conditions right here are precisely why we hedge right tails too. And I think it's a great lesson for everybody to learn in these markets. Especially if you are a fundamental investor, especially if you are trying to buy things that have some sense of reality baked into them, right? Because I mean, let's be honest. If you're chasing the hot names right now, you're not an investor, you're a gambler, right? Like if you're long Carvana at $290, you are not an investor. Okay, you are. I don't know what you are, but you're something. But you're a gambler. You're a spec. I mean, it's just, to me, that's just complete idiocy.
It's clear the risk of ruin turns you on. If that's what
100%. You're giving it a big hug, right? But that being said, one of the mistakes we have made in the past, certainly me, has been not getting bullish soon enough. And one of the painful lessons that I've learned over the years in drawdowns, because I mean, it has to do, with our style and what we try to do anyway, but there has not been a drawdown where we have not fared significantly better than the overall market.
Right.
The mistake I've made in the past is not taking advantage of that.
Right. And if you have a 20% drawdown and then it goes back up and you call it a bear market rally until it's 5% above the all-time high, like the damage there is so significant that it like almost doesn't matter.
Yeah.
It's cool that you got back in now, but like you need to get back in much lower.
Yep.
And one of the things I've, said internally, because like a lot of us are here wired the same way. It's probably why we ended up working together.
Yeah.
We all think it's a bear market rally, but of course we do. Like we did the last 5 drawdowns. We will the next 5 drawdowns.
Yeah.
So like there's a good chance we're wrong and it's not a bear market rally. This thing's legit.
Yeah.
That's why like I love little things like that Zweig bread thrust. Because it's like this thing tends to work. It fired off. I think it's BS.
Well,
we should buy it.
Well, the other thing, I mean, it was like I think it was the day after you talked about that was where I put that Nvidia position on the books.
It was the best trade we had this year, and it's the best trade we will have this year. Even if it doesn't make us the most money.
Yeah, it was
the best trade.
I mean, we had some pretty good Tesla trades, man.
Yeah, I mean, one of those I think was 70, 80 or something. So yeah, no doubt.
I mean, we were treating that thing like an ATM. And we tempted the fates again, shorting it again,
but out of the way,
we got out of the way. That's still an extraordinarily profitable trade. But I'll agree with you. The timing of that Nvidia trade, putting on as that right tail hedge, was the right move. And it's just something you learn over time, right? Like, you risk 5% on the underlying position. That's your downside. And we had a couple other ones that we put
a very
on too.
tight stop.
Yeah,
that's the beauty of it.
Yeah, you're just not risking a lot, right? The other thing is you're buying an expensive name, but you're not buying a BS name.
Yeah, I mean, I think it was like 22 times forward earnings or something. It wasn't that big a deal.
Yeah. But you also know it's on the list of, and it doesn't. Again, I've talked about Nvidia till I'm blue in the face. It doesn't. It is way real. Incredible company, incredible products, but it's on the list that the idiots want to buy.
No doubt.
Right, and so. The reason
globally,
yeah,
too.
right. And the reason I gravitated toward it is I was like, look, this is a good way to catch the idiot bid.
It's the supreme leader, as I always call it.
Yep. But doing it with some semblance of reality underneath you, right?
And we got lucky. They've had a ton of good news since, like pulling off, curbs on their products, and I mean now like the UAE's like, hey, can we get like a whole bunch of those? And the Saudis are like, we'll take some.
Yep.
So it's had plenty of real drivers too.
Yep.
On their last earnings call, they're like, like AI demand hasn't moved an inch. We're good.
Yep. What else you seeing in this market that's catching your eye?
The one thing I'll mention, and we talked about this morning, but in our meeting, if you go back to that November, December thing where, I mean, like, I know, like I was getting really bearish because the market was so frothy, but I remember like that's when I started talking about, hey, there's the potential for a market problem and for the rest of the world to really outperform based on the fact that it sounds like the new administration wants to bring down the trade deficit and do something about the budget deficit. And I think that's why the rest of the world has dominated the U.S. This year to date, is because that really look like they were going to go after those two things. And now we find ourselves here in mid-May, and it's like now it doesn't really look like they're particularly serious about either. So I think it makes sense that at that point, okay, well, now US is fine to move higher, and the rest of the world, like, I think will be fine, but it's not gonna. I mean, we just had we had a whole handful of countries beat the US by 20% in a quarter. Like, well, you're not going to do that anymore if the US isn't serious about trade deficit, budget deficit. So, but on the budget deficit, totally still up in the air. Like, I see a lot of people really trying to get a really, quantitative grip on what it's going to be. My buddy Matt keeps saying like, no, like the Senate hasn't touched it. Like, there's so many steps still left. There's no point in getting the calculator out. And I think that's fair. But what I will say is the current trajectory, it looks like
it ain't going down.
Looks like they're at least not going to. Yeah, it's not going down.
It ain't going down.
Will this bill be some massive blowout that pushes us up to 8% or something deficit? Like, maybe not, because there's too many problems in it for different, voters. But are they going to like cut the deficit with this bad boy? No.
Yeah. It's not going down. And and look, you and I have said too is. And this is one of the reasons that I think that you can get a lot more frothy here is because, look, and I think a lot of it is the passive thing. A lot of it is what markets are conditioned to. Again, we clearly know that fundamentals don't matter. And so if you have this environment where the deficit continues to grow, right, as long as rates stay stable and hang in there, and the S&P, even if it's just 1% at a time, keeps pushing up. Right. Those are the biggest drivers, the biggest economic drivers. So, you could have concerns about the economy, right? But if you tell me at the same time, when you're at 7% deficits, okay, that government spending is going to push higher and the S&P makes new all-time highs, I think that that's enough dry powder, at least as it relates to markets and asset prices, to keep pushing things higher, almost regardless of what happens in the underlying economy. Right. Just because I think that you've got this loop, this reflexive.
It's new money. I mean,
yeah. And you've got this reflexive loop that I think is built into markets, right? I think all the data points this way. I think it's almost, you can't argue the point, in my opinion. But, I honestly think you're at a point where that has a bigger impact than actual economic reality.
I think
because it's not enough to stop the flows.
Yeah.
You know what I'm saying?
And that's why the system's dynamic view of it is so important. And then that's the other thing is I mentioned the trade deficit, budget deficit. The other part with that was if those things were going to bring the market down becomes its own fundamental and it hurts the economy. But now that the market's going back up, that's not going to be the case. People are going to look at the 401ks and let's buy the RV.
Yeah, right. Yeah, so, we can help, and we can kick an extra $200,000 to Jimmy and Sarah and help them buy their first house.
Exactly.
Yeah.
So you're right back to the big drivers, the big things that can take you down are largely gone. Now I'll mention obviously the trade war can reassert itself at any moment. Duration, long-term bond yields moving higher from here in a meaningful way towards 5. That becomes, I think, a problem. And then the third thing we talked about this morning too was hey, look, if global money, especially Europeans and Japanese that have a lot of money here, decide that's cute that you guys got your market back up, and we're really happy the trade wars, been turned, the volume got turned down to 2 instead of 11. We still want a bunch of money back. That could also hurt us. And I will say something notable today was you saw the dollar, which we haven't hit the markets, but we did see the dollar go down today after the rip yesterday. And I mean, it's one day, who cares? But the dollar still hasn't made the same kind of comeback that everything else has, which makes you wonder, are some people still taking some money home?
My guess would be yes. And I was going to say that. I was like, look, I still think that the dynamic of the U.S. running and nothing else running, I do think that that's over.
Yeah.
I really think that, like we were saying before, I don't think that necessarily means the U.S. markets have to get thrashed. What I do think is the days of it running by itself are over. I just think you had that moment of awareness where markets woke up like you and I were talking about, and just kind of saying, look, we realize that we probably shouldn't have all been US, we're way too US focused. And then, you can't unring that bell, meaning people have been forced to look around internationally in other markets. And I just don't think they're going to unsee what they see. At the very least, if you're an international manager and you've probably been rolling on average, if you're a solid performing international equity manager, you've had to have been 60, 70% US stocks.
Or you weren't solidly performing. Yep.
There's no way, right? Okay, that guy
just happened to nail the exact right places, the exact right time, the thin markets. But
so they did. Yeah. Okay. It is anathema to me, knowing, we've got friends that do, we know people. It is anathema to me, virtually every, even if they're not an international manager, virtually every smart investor I know is at the very least going, you know what, I need to widen these bets out a little bit. Right.
Exactly.
Just spread that money around. And so I think that the drastic underperformance of international markets versus the US is probably over. Not saying that the US won't lead. I just don't think people need to go back and look at the charts to know what we're talking about. There has been it has been a one-horse town for over a decade.
Yep.
Right.
Very clear trend.
Yeah, I do think that's over. And you're actually seeing signs of that. Like today, we had several international markets ripping.
Yeah, Brazil was on fire.
Yeah,
today,
on fire.
For example.
Kate, that is a new dynamic because it wasn't very long ago when you saw the US throwing up a day like it was today. You look at everything else, it's flat to slightly down.
And to see the dollar down on a day where everything else is great in the US,
right? And
then to see some of these ex-US names doing well. Now, VEU, our proxy for the rest of the world, didn't hold up to the S&P, but some of those, hey, if you're picking countries like you pick stocks, like, if you're in Brazil and a couple other places, like, you're fine.
Yeah. You want to run us through the markets on the day?
Yeah, I'll do that, and then we should probably wrap. Or I should anyway. So S&P closed up 0.7, Q's up 1.5. Small caps up 0.38, equal weight up only 0.2. So this was definitely a Mag 7 story, up 2.2. Rest of the world was up 0.2. Then you had oil up 2.76. You had gold up 0.8. The rest of the metals up over 1. Dollar down that's actually worse than I realized. The dollar down 0.8 today.
Yeah, it's almost a 1% pullback.
It was way more than I realized. Now it had a huge day yesterday, so whatever. But and then 10-year yield up. I don't know if this is, but basically flat. But we went and tagged 4.5.
So the one thing I will say is that, obviously a lot of talk, and we're talking about, acceleration to the upside, things like that, blow off tops, all that being said, the other thing that I still think would make some sense and that I think is in play, is the potential for the kind of the boundaries of a range to be set here in the US. Because again, I don't think that I think you would be making a mistake if you didn't take into consideration the levels that we're trying to push off of right now and how richly valued this market is and how it didn't get cheap during this pullback. It's so funny. There's consternation and, it's just bizarre. I still try to wrap my head around the fact that people are like, oh, it's such a bad market, bear. And then you look and the S&P's trading at 23 times earnings. So, but I think that range trade makes a lot of sense. That being said, if markets are back in silly mode, which they're certainly showing the hallmarks. And like I said, you got really ridiculous stuff making new all-time highs now. I think you got to be prepared for anything. So that's about all we got for today. We will be back again tomorrow. As always, hit us up on social media, Google Google Know Your Risk Podcast, YouTube Know Your Risk Podcast. You can catch our new video feeds on TikTok, Know Your Risk Podcast, Instagram now. You guys know the deal. Anyway, Chase and I will be back tomorrow. And I'm sure it'll be another adventurous day. A lot going on. So anyway, we'll see you then. Have a wonderful evening. You're listening to Know Your Risk Podcast. Download and subscribe at knowyourriskradio.com.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.